Good afternoon, everyone. This is Tim on the Buzz at Relaks Radio. Now, we are talking on Thursdays. We talk with Chris Slater-Jones on how to, on all financial topics when it comes to, advice, if it is your personal, if it is, a corporate or even a startup, right? All kinds of questions around the finance topic. So we've got Chris Slater-Jones on the show today. And we've got topics around, if you are running a startup and what you need to consider when running a startup, if it's before launching, when you've launched it, or even if you're going into, a long-term phase when it comes to expansion. So this is Relaks Radio. We are on, YouTube, Facebook, Instagram, Twitter. If you want to reach out, feel free to call or message. Our number is 07852 473 473, and I'll be showing you a quick video on who we are and what we do. But coming right back to the conversation, we'll be back with Chris. Welcome back, everyone. This is Tim on the Buzz, and I'm talking with Chris today. Chris is our host for the day, our co-host for the day, bringing you, financial advice. Hello, Chris.
Hey, Tim. How you doing, man?
Good, man. Good. So we'll jump right into it directly now. What now? See, you running your financial advisory company. When it comes to this, and any startups for that matter. What type of considerations or questions do you get asked the most?
Having a startup is for some people quite intimidating, for others fairly easy. I think what most people have is they have an idea, they think it's going to work, they believe, rightly or wrongly, that working for someone isn't the right way to go, and they want to go on their own. So you have an idea, and where do you go from there? A lot of people kind of get stuck. And so then we start having that conversation. We start having a conversation from, okay, what do you need to do to test the idea, make sure it's something that can work in the short term, even medium term, and that you're not going to starve trying to test it or get it going. Because I've been there. I've left a job. I've started a company. It didn't work. And suddenly now you don't have a job. You don't have money. You don't have cash flow. And, you don't have an idea for whatever reason. And companies fail, not because the idea is bad or not because there's capital or not because of the person running. It could be for various reasons, including pandemics. I started this financial company in March 2020. So my timing isn't that great because here in the UK we went down to lockdown, but we are getting through it. So startups, the consideration, where do you go? I've got my idea. What do I do? First of all, try not to spend a lot of money setting the idea up. You don't need to. You've got access to your own private network that you can test it. So speak to people, speak to your friends and family. Is the idea worth it? Would you buy this product or service that I'm looking to market or put into the marketplace? If you're getting positive feedback from there, that's great. Then have a look and say, okay, how do I get this to a bigger audience without costs as well? Because I think it's quite important. For the first maybe 5 years, you want to be quite lean. Unless you have some brilliant idea that takes off, which is very few and far between, because if you look at all the largest companies, and these days it's the tech companies, right, with the Zuckerbergs and the Jeff Bezoses and these guys, if you go to the early days they started and the Googles, these companies didn't make money in the beginning. They had to self-finance, self-fund, and then get other financing, and so build up the steps. So right in the beginning, you want to say, okay, you don't need to create a company right in the beginning either. You can do what's called a sole proprietorship, which just means it's me. It's, and I've got this product and I trade as whatever you want to trade as. You can
where
choose
you
whatever
own
name
100% of the shares initially, right?
Yeah, there's no shares. I mean, people kind of think that if you've got a startup, you need to kind of have this company, you need to have these shares, you need to have bank accounts, you need to have accountants. You do, but once it's running, once there's cash flows coming in, and once there's legal requirement, right in the beginning, if you've just got an idea, and unlike financial services or any other highly regulated market, which is the profession, so unless you're starting an accounting firm or a financial firm or a law firm or a doctor's practice, you generally don't. If I'm just, let's say I want to supply pictures, and I'm making pictures, and I want to go sell them online because I think this is a good idea, and I'm pretty good at drawing. I'm not, but let's just assume I am. I don't need to start a company. What I can do is just put up a website and put my pictures on there and sell them to people and have it coming into a bank account. Now, there is tax that's owed on that and various things, but that aside, it's quite legal to do that as long as you are, going along with the tax laws and various laws that are in your country.
So let's say by chance now in the UK, if I want to start my company, let's say I've got, what is the process there when it comes to the financial work, or like you said, the tax is a concern. If I am either a sole proprietor or if I'm going into a partnership, what type of questions or who do I go to when I talk to all these, and what's the most convenient or efficient way you would recommend?
Exactly. So look, first of all, I'm not an accountant, so I'm not a tax expert, but I do deal in it. So this is not advice in any way. But generally, if you a sole proprietorship, that tax is in your personal capacity. Okay, so it's seen as income tax. So and that'll be taxed appropriately as you put in what's called a self-assessment, or you're reporting in the UK into HMRC.
Right.
You have, in the UK, you have limited companies. Basically, that's it now. They've reduced it all. And there's two main limited companies. One is the public limited company, which is those companies that are generally listed on the stock exchange, or they are companies that are allowed to sell their shares to the general public. And then you have private limited companies, which most of the companies in the UK are. And the reason we use a limited company is because if the company gets wound up or closed, or the owners or the directors, as they're called in a limited company, and shareholders are only liable for what's in the company, right?
Correct.
So there's no personal liability. So
I think we need to ask ourselves here in what type of how we could come to now when you talk about this type of situation for a company, you mean instances like debt, or it's in those lines basically. So
look,
how
you can't go incurring debt, okay, because there is legal requirements as a director of a limited company. There are also integrity and morality rules. So if you incur £1 million of debt on a limited company, and then close the company and take that money, well, that's fraud. You personally will be liable for that debt, because most agreements in that thing have a covenant where it says severally and individually liable. So while the company is a separate entity to itself, they generally have you stand as surety for the company. So just bear that in mind. Okay.
Right.
But so a limited company, and a limited company is fairly cost effective to set up. I hazard a guess, it's probably around £15 to £60 to set a limited company up, and you can do it online. and you get what's called memorandums and articles of association, and they just set out the rules in your company. And it does get quite complicated, and it is worthwhile seeking, proper advice on this, because what you want to make sure is that your company can do what you want it to do legally.
Right.
When you set up a company, they want to know what the company does. So if you're selling goods, you're selling retail, you're importing and exporting, you need all those things. So let's just assume it's a general limited company, which is fine. Or sole proprietorship, which is just you on your own.
Yeah.
And there's disclaimers and stuff. Now you have tested your idea with your friends and family, and now you want to go to the next step. And the next step generally then is kind of releasing it to the public in a limited way, which in this day and age is usually you set up a kind of a one-page website, which is a little advert kind of thing. You don't necessarily have to have the online purchasing portal ready. And I would actually say don't, because that involves other agreements, and it can get quite expensive if you're not transacting in a certain way. And then you probably do an advert on Facebook or set up a Facebook page and LinkedIn, and you start to get inquiries. But now you find, as the inquiries grow, you need capital, because it's an interesting concept, right? If you are providing a service, you don't need as much capital as if you're providing a product, because of course, if you're providing a product, you need those costs to make the product and then sell it. So service is generally easier, a little bit more abstract, where people can't really, it's not tangible. But if you've got a product, a couple of things to be wary about with a product. Do not go and buy a whole lot of stock before you sold it. I mean, I've made the mistake, and you sit with a room full of stock, right? And it becomes
in what instance now, if we are to say that you could actually sell too much of stock, sell too much of the company, and in what instances do people make this mistake where they do this? Because it could be to raise capital, it could be to get out of debt. How would you say we could avoid problems like this? Or when it comes to the initial stages, what are the mistakes that people make in majority, and how would you reckon to avoid these mistakes?
Yeah, and that's a good question, actually. So I think there's a few key mistakes there, and it goes back to last week when we were talking about cash flow. Cash flow is king. So I think if you have a job, you're employed or something like that, keep that job and start the company on the side, so that you have the cash flow, right? So that you're not dependent on the company for your own income. If you can do that, you are so far ahead of the game. It's unbelievable, because that alleviates a lot of stress. It doesn't. Yes, it can be harder, and you are going to work longer. But don't go into your own company if you want to work less, because you won't. You won't work less for a while. It may happen, but you won't work less for a while. So work a bit harder, work a bit longer. So that's the first thing. Don't cut off any cash flow that you already have. If you're not in that position, then one of the mistakes, if you're not in a position where you have cash flow, is that you don't have enough capital, or you don't foresee the length of time it's going to take to bring money in, or cash flow, or profitability. People say, well, I think in 6 months I'll be okay. Okay, what if it's 12? What if it's 18? What if it's 24? And like most things in life, it's generally longer than you think, a lot longer. You can say, oh yeah, but I spoke to this guy and he said he would do it. He said he would buy it. And now I've chased him for 2 months and he still hasn't done anything. Right? We've all got that story.
I think anyone running a company, especially last year, regardless of which point of the lifetime in the company you were, especially last year till now, you've definitely had to consider, or even bring into consideration, of the fact that you might need a safety cushion in terms of capital. So I totally agree with you there. When it comes to so to add to that, Chris, now if there is a particular way as to a method initially, because what a lot of people might do is you get the people that might analyze beforehand, try to map it out perfectly and then approach the market. But you also get the other type of person that just goes all in, and then learns it on the go, right? So, which, I mean, I'm assuming, it's a mixture of both. But, when it comes to financials and, let's say, things like estimating, budgeting, how would you reckon, if it is marketing, if it is for the team, if it comes to expansion, if it comes to things like transport or, other admin operations, how would you reckon to, do you reckon, investing in high talent or experienced talent where you can basically find a better ROI faster, or how would you say to go about that?
Yeah, a big question. Firstly, there was I heard it years and years ago, so it's not my definition of an entrepreneur, but I like this one, and I heard it from someone. They said an entrepreneur is someone who jumps off the cliff and then builds the plane on the way down, right? It's like,
I've heard that as well.
Yeah. So I don't know who said it, but it's an interesting analogy, and unfortunately, it's not true, because there's a few that can do that, and I'm talking out of 8 billion people, maybe 5. I'm certainly not one of them. So you're right. You want to be somewhere in the middle. You want to be someone who takes the risk, but then calculates that risk, and also understands that it's never going to be perfect, and it shouldn't be, because you want to be able to adapt and grow and learn as it goes. Because if you get the perfect business today, I promise you tomorrow it's not going to be perfect anymore, because the world changes and people change.
Absolutely.
So you want to be adaptable.
I've read somewhere that, just hold that thought for a second, Chris. You can definitely continue from where you did, but if we are to, talk about, how fast the world changes, I read somewhere in the lines of, that Tesla, for instance, when they consider their lifetime in the business, they consider 3 months to, 12 months short term, and then 3 years is long term for them. So they are consistently adapting and, innovating rather. And even when it comes to Google, I read somewhere else that they have a structure, they have the skeleton of a dinosaur in the building, and how, the reason for that is to show that if you don't keep innovating or adapting, you will be left behind. So, like you said, things are changing real fast, especially today. It's changing at an exponential rate. The way people are getting on or integrating software into different businesses, regardless of the vertical, right? So that is definitely there. So you reckon for someone to go somewhere in the middle of those two options there, right?
Yeah. So you want to be calculating your risk. You want to be looking at what you're doing, and it's never going to be perfect. How you do that, and I'm a finance guy, so for me, most of the business plan, especially in the initial stages, because you don't need to put a whole business plan together, but I think you've got to have some kind of plan where you've reduced your thoughts to writing, and I think that's important, because when you write them out and then you reread them, it sometimes changes what you think. Oh, okay, this looks better, or this isn't as good. And what's important for me is, and I've looked at a lot of businesses, and I've looked at a lot of businesses to invest in, and as a stockbroker, we used to analyze businesses, and the financials tell a story. All financials of all companies tell a story, because it's the real way we can assess how a person thinks about their business. If it's a public company and it's busy trading, we look at those finances to see how management is directing funds to where in the company, and how those funds are being utilized and what's going on. So it tells quite an important story, because you're going to ask a manager what he's doing. He says, I'm doing the best job in the world. But if you look at the finances, then you can actually see how that job is being translated. And it goes all the way back from the corporations all the way to the startup, where you start with the financials and then build from there. And I'm not talking a full book of accounts. What I'm talking about is you put a page down and you say, okay, what do I expect to come in and what do I expect to go out? Bottom line, you don't have to get any more fancier than that, right? So that now you're starting to think, and then people go, okay, so if this comes in and that goes out, because now I've got some costings, How much profit am I going to make? Because most people don't even look at this or don't even understand this. We talk about GP, right? It's an acronym for gross profit, which is the profit made by a company before tax. Okay, EBITDA. Don't worry about EBITDA. It's just before tax for now. And you need a figure on that. You need a 20%, 25, 30%. The first thing I ask people in their new business is, how much GDP are you looking to make on this? And if they can't say, no, I reckon about 25 to 35% off the bat like that, they haven't thought it through correctly. And I think, oh, come on, guy, we're going to go back. Let's do the finances and have a look. Because if you've got your GP, then you can see what the rest of the market is doing and how you compare. And that also translates into your budget. So how are your costings working? Can you get it cheaper later on if you go to scale? Can that GDP go up? Also, how's your cash flow translate? Because if you've got all that in line and correct within your specific industry and niche, the rest gets easier, because now you can start to have a look and say, okay, I've got my little financial sheet. I've got a little bit of a marketing plan. Let's say it's a 2-page document, right? And that's all it needs to be. 1 page with your debits and credits on, and the other page with I'm going to have a Facebook page, I'm going to have an internet website, and I'm going to talk to my friends and family on a daily basis until they give me 5 leads each. Perfect. Great business plan. And I'm going to sell this at that, right?
Yeah.
That can now be tested. Then you can go into marketing and do that plan, right? It's nice and easy, it's nice and simple, and hopefully it's not going to cost you a lot, because now there's a little bit of cost coming in. Let's say £1,000, £2,000 or whatever, for some stock and a website and things like that. Then you get to the next stage. Now that works. Let's say that works. You're still working full time. You're doing this at night. You're tired. You're harried. Kids are running around. Wife's waiting. Yeah, I mean, it's just ridiculous, right? Now you get to the next stage where you think, actually, as you just said, you need staff, or you need to expand, or you need to get big because you just can't handle it. First thing I'd say was staff. I have hired staff throughout my whole life. I've also unfortunately fired staff throughout my whole life. I've also managed teams in a corporation that I didn't hire. And so I've got quite a bit of experience on that. And I'll always hire attitude over qualification.
I'm 100% with you on that.
Yeah. People mix up education with being smart. And that's not, if you're smart, you generally have an education. But if you have an education, you're not always smart. So, it really doesn't translate. And if you've got the right attitude, anything's possible. I mean, it's ridiculous. So yeah, always have the right attitude. Don't worry about when I do. And here's something which is interesting. When I look at CVs, if people do, they send me CVs for my financial company. I don't want the gender on it. I don't want the race on it. I don't want the name on it. Why? Because I want to look at this as objectively as possible. And I'm, an open guy. I don't care who you are. I want you to do the job correctly. So that's why all of those must be removed. And you can look at that CV on an objective basis and see, okay, practically, can you do the job in my industry? Do you have because we have a few check boxes to go through. And then secondly, I then call you. I don't want to see you. I don't even want to see who you are. I just want to hear your attitude. I want to hear your energy. I don't ask, what is your goal in 5 years' time? Holy mackerel, that is the most irritating question on the planet. And if anyone asks me that in the interview, I just get up and walk out. I mean, it's like ridiculous, dude. I mean, seriously, how do I know what's going to happen in 5 years? We just anyway. But you want to extract the attitude. So it's like, how do you feel about yourself today? What do you do for hobbies? What do you do outside of work? Why are you looking to work here? Because are you looking to make money and there's no wrong answers. It's just, how do they feel about themselves and, the way they're going to conduct themselves going forward.
And you need to know how you are, what they'll be expecting, rather, if it's, if it is cash flow, or if it is, social status, if it is just a switch in or learning experience. It can vary with people, right? So
it can. And look, most people, and we're getting into a bit of psychology here, but most people need the security of the salary and the money at the appropriate level, right? So you take care of that. But
absolutely.
but that definitely only goes so far, because for any person, no matter how risk averse they are, the money will eventually not be enough, especially if you're an idiot boss and you're not looking after them correctly. Most people take the money, but they also want a good environment. They want an environment where they're contributing to. So that's always important. So if you are a first-time employer and you haven't hired someone before, it's not your right to tell them what to do.
Absolutely.
They have a job spec and they can do it. And if you hired the right person, which we never do, but let's just say you do, you should be able to just let them get on with what they want to get on with. You don't micromanage. I'm a very soft touch manager, but I've been doing it for a long time. I think you've got to learn through those mistakes. So hiring staff. Now, what gets interesting is if you hire staff to expand, you're still working at another company while you're hiring staff. A good book to read is called Shoe Dog, which is the Nike founder's biography, right? That shows how he worked as an accountant while setting up Nike. And I think Nike had 4 or 5 employees while he was still working full time.
Right.
So this, and that to me struck quite true. It was like, okay, this is how you do it, man. And this is how most of us can do it. And so you get your employees. Once you get employees, now this is the trick. You've got 2 options. You open a company and you become self-employed, meaning you have to work in the company every day in order to make a salary or a wage or your living. That is self-employed. You open a company, on the other hand, to start a business. That's a whole different perspective and thought process, because now you are opening the company up so that sometime in the future, you don't have to work in that company every day to make a living. You leverage other people. You leverage other people's work. And you do it by adding value, not only to your employees, but to the larger public, and that's how you do it. But it takes a very different mindset. Most people that I know that have their own companies are self-employed. They have to go in there every day and make it work, right? And they can't switch the mindset to
Delegating.
It is delegating. You're absolutely right. It probably comes back to control, right? They want to control the business. See, for me, this company that I've started, hopefully in 5, maybe 10 years' time, it'll just run. It'll do its thing, and people will be running. I don't need to control it. I just need
you, as the entrepreneur, you build the system, right?
That's it.
You're not. I mean, you build the system and then let the machine run by itself. You obviously need to give it attention, but to add to that, now in a financial aspect, Chris, what would you say if, let's say if someone approaches you at CS Jones and talks to you about how they want to be? Now I agree with you on the concept of working full-time elsewhere, getting your salary there, so your capital expense or your burn rate is lower in your company.
Easiest way to do it, right?
Yeah, but when it comes to making sure that things are going all right, this is a big insecurity built among all sorts of entrepreneurs. Even if I've watched a ton of Shark Tank as well, and they talk about how they want things to the detail, and this can leave them from growing as well, can hold them from growing. So my question is, how would you look at showing them the ROI there in a financial aspect, where if they could rather push that capital towards an asset or an employee and delegate that work, just trust the process and then work with it over time? How would you speak in financial terms to convince someone that would be a better solution? Obviously, it depends on the case, but
look, first of all, every financial option for a company is based on the person, not the person giving the finance, but the person asking for the finance, because they buy people. All good investors buy people, right? Because an idea is an idea. Ideas are cheap. Ideas are worthless. Ideas, have nothing unless there's action attached to it, and unless that action leads to measurable results.
absolutely.
So we understand that. So if you, from all the financing options that you have, they invest in that person. So that's why if you go, and well, let's start at the beginning. So you go, your first financing option is generally family and friends, right? You go there and you say, this is what I'm doing. And that financing option is usually to cash flow yourself for the first year or so. So it's kind of your salary so you can build the company, right? Which is generally what happens. The second option from there, it starts to open up a bit, especially if you've got a proven concept. So going to the bank for a loan, going to venture capitalists, going to private equity, going to any other professional cash flow or startup funder, you need to have proof of concept to hand before you do that. It just makes it easier. Because if you're talking, So
when you talk about proof of concept, where would you reckon you get this from? Do you need this from someone that's been working in the industry? What if it's a new industry and
what's it? Try and do it. So let's say it's a brand new industry. Things hadn't been invented yet. I had no money, which I generally don't, so that's okay. But and I'm looking for funding for my company. So the first thing I do is I try and get proof of concept going. I try and do something in some way that shows that this works in the real world.
Correct.
You look at Mark Zuckerberg. He didn't get funding because he had the idea of Facebook. He got funding because he had Facebook. He had already done it. Yes, it was in a format that was very different to what it became once funding was there, but that didn't matter. The underlying concept was still there. Google was the same. They received the funding once they had shown what their algorithm could do in the real world. All of these things are the same. So you need to have proof of concept no matter what you do. Be careful of getting funding, though.
Yeah.
Most people think, get funding, it's roses, we all go ahead. You get funding, you're now working for someone else. Just remember that.
So there, I think we can probably dive into that after a couple of videos here. But so just to talk about what we'll be, let's say, talking about. This is coming into the investment part, and this is coming into giving shares out of your business. How much of control do you need to give out? In a financial aspect, there's decisions that need to be made, and you, like you said, you are working for someone else at this point. Let's dive deeper into this part, but before that, we'll show you a quick couple of videos on who we are at Relaks Radio, and how you can actually reach us. You can call us up on 07852 473 473. That's the number on the screen right here. We are streaming on Facebook, Instagram, Twitter, and YouTube. So feel free to let us know, or you can also comment on this video right here to ask Chris a question, and we can have that answered. If you are running a startup, you can share this video with your friends or family running a startup, where you can help them learn about how to run their businesses as well. So we'll show you a couple of videos on who we are at Relaks Radio, and we'll be right back after this. Good afternoon, and we are back on the buzz talking to Chris Slater-Jones on from CS Jones, financial advising firm. Now, to talk to you about how go further into the conversation about, we did talk about making forecasts for your company if you are a startup and what you need to consider in terms of hiring. We are now diving deeper into the investment part of things when you are growing the business, what you need to consider in terms of financials and negotiating. So stay tuned here. Now we are adding Chris Jones to the stream. Hi, Chris. We so talking further into the topic about investing. We were talking about how you need to consider how much you're giving out, and what power are you actually looking at sharing with your investor.
Look, it depends on a few considerations there, right? How much you're looking for, and how you are valuing the company. And what I'd also say, I was thinking through it during the break, is a lot of people would be very good and focused on the product that they're offering or the service they're offering. So very often they're experts in that, and they neglect the financial side. They think, well, it's the finance side. However, if you are looking for funding from a professional funder, that is the side that matters to them. Yes, they can see the idea and they'll get even excited about the idea, and they'll like you as well as a entrepreneur who's very keen to get this thing going. You've got the energy, you can do it all. However, if you don't have at least basic grasp of the financials, you don't need an expert's view of it. You don't need to be an accountant, but you do need a basic grasp, and you do need to be able to talk to them in a way, as you just said. What financial terms would you use, and how would you use them in order to get funding or convince the funders that what you have is worth investing in? So it goes back to the kind of earlier in the show where we were talking about getting the business plan together when you first started out with your idea. It goes back to that accounts. How did you set up that budget? How did you come to those profit margins? How did you come to those costings? What did you do? Because that's all important. That all counts. Because if you have a business, whether it's scalable or not, what is probably one of the most important things, especially when you're starting, is the set of accounts that you believe will happen in the future, because that's going to drive most of the decisions. And if you're sitting in front of an investor and he's going to put money into you, so that the only reason I'm going to place my money in your company is because I believe you're going to give me more money back. I mean, that's, it's not rocket science, right? And I'm going to have a better belief in you giving me my money back if you understand how to use the money in the company efficiently. And that's what that account is telling me as the investor, is how you're going to use this money. Yes, it may go on staff. Yes, it may go on products. Yes, it may go on advertising and various other line items that, all companies have. But how are you going to allocate that? What's your timing? Where's the cash flow? How is that going to be offset against future profits? All these kind of things. So let's unpack that a bit, because I know I've covered it in broad detail. What do you need to take? What do you need to consider? So you do what's called a profit and loss statement, which is basically exactly what it is. When are you going to make a profit? Because no company starts off making a profit. If you've done a spreadsheet and you've put some accounts in it and it makes a profit from day one, you've done it wrong. It's not gonna, because it's not gonna happen. I mean, well, it may, but if it does, let me know, because I carry your briefcase. I'm going to be your secretary. So yeah. You sit there, and this will be a monthly thing. So you start, I don't know, I don't go January, February, March, April, May. I generally do month 1, month 2, month 3, month 4, because that allows, it doesn't stick us into a certain time frame in the year. And then you do a 5-year projection. So you go, okay, what's going to happen? And it can be fairly static, and it can be quite involved. So you can, add in things like inflation and increase in costs and things like that. Part of this profit and loss statement comes from another sheet, which is the number of clients you believe are going to buy your product or service. So, and that's got to show, of course, increasing, but it's also got to tie in, this is where it all ties in, with your proposed marketing plan. So if you say, I'm going to speak to friends and family, I'm going to have a Facebook page, I'm going to have my web page, and that's my marketing plan, but I'm going to have 10,000 clients, I'm not going to believe you, right? Because it's not a very dynamic marketing plan. Yes, you could probably get 10, 15, maybe even 100 clients over a period, and it's a good test and start. But if you're not actively marketing and going out there and doing things, you're never going to get, a large amount of clients. So that's got to evolve as well. So that's the first part there.
So when it comes into the just remember where you stop so you can continue from there. But when it comes to the conversation of adding someone onto the company in terms of a shareholder, how would you say would be most attractive for them, just to add to what you were saying, in terms of expansion, in terms of expanding the team, in terms of picking the investors to see if they're actually beneficial apart from just the financial aspect? How would you reckon, approaching this?
So my personal experience is having additional shareholders and funders in your company it's a tricky business, very tricky business. I mean, if you look, it's quite easy, right? You can just go onto the internet and look at venture capital firms. And if you dig a bit deeper, you can see how many investments they make a year and how many actually come through. And it's quite a small percentage that make them the money. And they invest in quite a large amount. And failure for these firms or companies, startups, are varied. It's you can't pinpoint it. So what I would look for if someone was investing in my company is I look for someone who will give me reach beyond what I get, either networking or knowledge or product enhancement or things like that. So, which gives you something beyond any financial gain, which is important. If you're selling a product, generally they have access to factories that you wouldn't have access to, or costings or various bits. If it's a service, they have access to networks and they can open doors that you wouldn't be able to do. And then based on the amount and the industry, i.e. the risk of the industry, because all professional funders will have a matrix of risk by industry category, and that will kind of define the shareholding for them. If it's high risk, they may require 80 to 90% of your company. If it's very low risk, that will go, I doubt it'll be below 5%, but it can go down as low as that. If you can maintain a controlling interest, fine, a controlling interest being 51%, but what is a controlling interest and why would you have it? I mean, if you're a startup, the only reason you have a controlling interest in a company is if you want the sole decision yourself to sell the company. That's all.
Yeah.
Because the shareholder doesn't run the company. Directors run the company. Managers run the company. Employees run the company. And while you may be a shareholder and a director, don't confuse those two roles. As a shareholder, if you have a controlling interest, that's all it is. Yes, you can sell the company when you want and you can do various other bits, but it's useless if you've got no cash flow or no company. So don't get too hung up on a controlling interest. What you can do, though, is let's say you get a company and they're interested in funding you and they want 85% of your business because it's high risk or, for various other reasons. But now you'll get the funding, you'll be able to go and they have other value to add, such as networks or products, things like that. And you can see this is quite a good way forward. What you can do is because you'll have a shareholders agreement. That's the contract that is put in place that allows you to transfer the shares. Okay, and it'll include the price, it'll include what the shares do, because of course you go into all that nitty gritty, i.e., there's equity shares. You could also have a different class of shares if you wanted, but let's just keep it simple. Let's say you're just selling equity stock, and the main shares in the company allow for voting rights. They allow for various other entities, such as one of the funds become a director. They get a seat on the board. You have annual general meetings and things like that. So there's a bit of admin to do in that. But you can also have things such as gateways. So I remember one of my very earlier businesses. It was a tech business, actually. So it was quite high risk. So most of the equity went. It didn't work out. It all collapsed, but that's needless to say. But I put in gateways there. So I said, okay, if the business gets off the ground and gets to point B, from point A to point B, which is either defined as a product development or more often than not a turnover or a GP figure, gross profit figure, then I will be entitled to buy back 5% of my shares at the costing at that time. And you have that formula in there. This is where the understanding of finance helps, right? Okay. Because now what you can do is you can create a vested interest, meaning that both parties want this to work because they're getting something real and tangible out of it. And the professional funder actually can offload their risk through the term of, let's say, 5 years, just as an example, 7 years, while still maintaining, some involvement in the company. And it's not for all the shares. Let's just say they're about 80% of the company, and you have the share buyback gateways as you reach each level per year, up to 49%. So you now have 51%, they have 49%. But what you do, and you try and be a little clever about this in the math with your accounting, is their initial investment gets paid back to them, with them only having to sell 31% of the shares in this example. Next to that 49, now you've got controlling interest. So you can do that. So don't get hung up. My point is, don't get hung up on holding a controlling interest in your company initially as a startup. There's ways and means to do it. Rather get it started.
Yeah. That's a new, to me, relatively, that's a new approach. I've come across instances where people have done that, but I agree with what you're saying there, because again, it depends on how much I think you influence the business as well as the entrepreneur or the partners of the business. So in terms of relationship there, or in terms of decisions, what is your take on how to decide on who decides what, and what types of financial considerations do you need to agree upon before you sign that sheet of paper with your new investor or partner?
First of all, you've got to make sure of liability.
Also, Chris, just to include in that, which when it comes to the question of including your investor, how would you suggest a model that if you are keen on, maybe now I agree with what you say in terms of giving more of the business, because eventually when you show results, you can demand or you can buy back your percentage of the shares. But in the instance of you wanting, let's say, more money apart from what is already paid for to buy into the business, what type of model would you reckon? These are just other questions that we could answer maybe while you're answering these. So two things were the models in agreement. The second is what considerations or decisions need to be considered when making decisions for running of the business long term before you sign the paper.
Yeah, so what I was going to say is you start with the liability. So what are you liable for if everything goes wrong? So if they give you money, on what basis is this money coming across? because sometimes people can get stung, right? Where suddenly they have a debt in their personal capacity. So make sure that you understand that. And also, if it is in that basis, try and negotiate it out. People just think an equity deal is an equity deal and they don't read the paperwork. So read the paperwork or ask the question. Secondly, how is that money going to be paid across? Because there can be an assumption that the money just comes across. That, oh yeah, there's a bank account and we're going to put all the money in the bank account. That very often is not the case. It's not how it works. They would have their own gateway system where we'll give you an initial amount and then you've got to reach that point. Then you've got to get to point B before you unlock the next amount. And that's traditionally the way it's done. So make sure that you understand those points, and those points are based on your reality or what you expect the company to be. Because there could be two realities, and I've seen this fall down quite quickly, where a business plan has been presented and the venture capitalist in this case said great, but they put additional gateways in. So there was an extra 20% that was needed to unlock the additional capital, which didn't happen. And so the business closed, and then the owners were saddled with the debt as well. So you need to understand that and be upfront. Just say, hang on, this isn't what we put in our business plan. Why is that the case? And I know it can be quite emotional because you think, oh, I'm not really funding. But there are plenty of other fish in the sea, and rather than get saddled with debt or have a business that falls over or get taken away from you, have that done up front. So those are the two main considerations. For people making decisions, if you are on your own or it's just you and another partner, I would always get a third party in. We talk about the nomad. It's someone who is just there to disagree with whatever comes up around that director's table, not to be argumentative, but to ensure that we are discussing all possibilities. It just lowers the risk of us going down one track without actually looking, because it's so easy, right? I mean, you're so busy. And I had 2 meetings before this. Straight after this, I'd go into another meeting. You just get like this. So you need to have some perspective. And I'm not talking about your funders here. I'm talking about like a non-executive director, but can be friends of family.
So would you reckon having them as a shareholder on board or as a director straight up?
No, just as a director. You don't even have to make it official, right? They can just sit there and have them sign an NDA or be a bit formal about it. But generally, what we would do is we would appoint a non-executive director, meaning this is a person that sits on the board. They do not run the company day to day, but they are a consultant to the board in their capacity as a person, basically. You can be a non-executive director like I am in regard with finance or accounting or things like that, but generally if you're just a startup, just get a mate to give you some perspective.
Awesome. So
what was the other one? Did I answer both?
The other one was in terms of the model as to how you should consider getting the investor on board. That's
a big one.
Yeah, I think we're a little short for time. We're just about to have to wrap up. But yeah, any other questions or any other considerations you've come across at Slater-Jones in terms of what mistakes people could avoid? To all the people that will be listening to this, any considerations apart from what you mentioned that the people or young founders or businesses need to consider when expanding or growing the business?
Look,
just before we head out.
Don't wait for it to be perfect. Do something. Always do something. I mean, action is the variable. And then focus your action. That's where plan helps. Because doing action, building a website when you've got to be speaking to clients is not the right action. So focus your action to possibility. Don't look for finance if you don't have to. Try and self-finance as much as possible. Because the more you do that and the more complete your business, the easier it is to expand later on.
Yeah, I'm with you 100% on that. I agree with you on that. So we are gonna have to wrap things up for this week. Thank you, Chris, for joining in and sharing all the advice. Appreciate it as always. If you are interested in, if everyone listening wants to, come in and listen as what considerations as a larger business or a corporate you need to consider. We can even get into the cryptocurrency conversation that we sparked up last week, maybe later next week or the week after. You feel free to. What's that?
Now, I'm just saying, cryptocurrency, we can talk about it, but Elon Musk has pulled out of Bitcoin now.
Yeah, he has. It's all
it was
looking
just funny.
red.
We mentioned it last week. Yeah.
Exactly. It's all looking red today. I just remembered you as well when I saw the news. So because of the Thursday show. So we'll anyways get the conversation. We'll continue this conversation on next Thursday. And we'll be talking about how a larger business needs to, when it comes to financials or anything to do with advice, how we can, approach different problems and getting a bit of advice from the financial expert, Chris Slater-Jones. Thanks, Chris, for logging in. Appreciate your time. We'll see you next week.
Cheers, guys. Thank you.